Hi friends, welcome back to Murthy Finance Academy. Today we will be discussing one interesting company from pharma spaces, Neuland Laboratories. But before we proceed, a quick disclaimer: I am not a SEBI registered analyst. Whatever the companies we are going to discuss are purely for educational purpose. The company Neuland Laboratories revenue grew 11.4% year on year to 447.8 crores, while EBITDA contracted 6% and PAT plunged 60%. The latter is a victim of the high base and last year's extraordinary property sales. So commercial CMS projects now anchor the ship at 50% plus of revenue, supported by a massive R&D migration to a 140,000 square feet state-of-the-art facility in Genome Valley. The real question: can Newland successfully transition into high-scale peptide and NCE manufacturer without the inherent lumpiness of the CDMO business, breaking the retail investor spirit? If you are staring at the top line revenue and panicking, you are missing the forest for the trees. This dip is a strategic byproduct of intensive capacity building. Between the Unit 3 ramp up and the July peptide commissioning, Newland is swallowing the short term operational overhead to prepare for a significant larger scale of execution. The Indian API landscape is undergoing a tectonic shift from commoditized high volume generics to specialized new chemical entity manufacturing. While giants like Divi's Labs and Torrent Pharma operate with massive footprints, Newland has carved out a distinct identity by ruthlessly pruning its portfolio. Company long ago abandoned its quality focused API roots, symbolized by its exit from legacy low margin products like ranitidine, to pivot toward a human health focused CDMO business. The goal is no longer just being a supplier but an integral partner for venture backed biotechs. These innovators don't go volume focused giants for early stage clinical batches. They need the developer mindset that Newland offers. The next frontier is the peptide modality with large scale capacity scheduled for commissioning this July. So, company founded in 1984 and headquartered in Hyderabad, Newland is a sophisticated player bridging the gap between custom manufacturing solutions and generic drug substances. Physical expansion is aggressive. The Unit 3 scale up is underway, and the R&D move to Genome Valley provides 140,000 square feet of runway. Financially, the business is high quality, sporting a 14.8% ROE and 18.7% ROCE. So, Newland's competitive advantage is its agility in process design for complex molecules. Unlike larger, more rigid competitors, Newland acts as a process architect for venture backed biotechs. They engage during early clinical phases and remain the partner of choice as molecules transition to commercial status. This agility creates a sticky relationship that volume centric players struggle to replicate. So, Western peptide manufacturing is hitting a wall. The explosion of GLP-1s and the similar analogs has led to a saturation of capacity in Europe and the US, creating a massive opening for high-end Indian CDMOs. The compound math here is transformative. Historically, a successful CMS molecule contributed nearly 30 crores. Today, Newland's pipeline features multi-hundred crore molecules. As these commercialize, the mix naturally gravitates towards 30% EBITDA margins. The market is missing the preordained nature of this growth. The existing commercial molecules provide a clear execution floor, while the peptide pipeline future segment remains an unpriced call option. So, strategic tailwinds are blowing hard for Indian CDMOs. The India EU deal, which is expected to lower procurement costs for European pharma, while US India trade discussions emphasize API security. So, the NCE drug substance space is expanding as global innovators seek China plus one sourcing to diversify supply chains. Coming to some headwinds, raw material volatility remains as a thorn, and there is a persistent underlying intent from the US to eventually secure domestic manufacturing for critical APIs. So, if you see its CMS commercial segment, which is the primary engine contributing 50% plus of revenue. This is the high margin driver. And CMS development segment, a robust NCE pipeline where white space identification leads to future commercial anchors. And coming to prime GDS, is it buying the high volume workhorse likely to drive near time segment growth? And prime ZDS of mirzapine, an established mature molecule providing steady cash flows, and its specialty GDS, apixaban, a major growth driver in the high value generic space, and its paliperidone, a drag this quarter due to customer and operational delays. And coming to its peptides, the future segment with a critical July commissioning target and unit 3 capacity, the physical enabler of high value volume shipments. In CDMOs, lumpy quarters are a feature, not a bug. Evaluate this business on a 3-year horizon or don't own it at all. So coming to its revenue, there is a 11.4% year-on-year growth is respectable, but the uneven delivery flow remains a dominant theme. Coming to margins, it reported EBITDA was 19%, but the normalized margin is 21% after adjusting for a one-time 10 crore labor code impact. Its gross margins also stood at 52.1%, were suppressed by a lack of high margin CMS shipments this quarter. Coming to its balance sheet, it is having a negative net debt of 202.6 crores is a fortress. Coming to working capital at 145 days, this is the elephant in the room. Management claims they can run 90 days via inventory optimization, but current inventory ramp up as a precursor to revenue makes this a tall order for the next 2 quarters. Coming to earnings, PAT of 40.4 crore looks weak only because of the massive high base effect of previous property sales. And coming to RPTs, the Genome Valley release is a strategic necessity. Building the state of the peptide scale up capabilities requires the specific infrastructure. So Neuland is effectively cash rich with zero net debt, while this quarter margins look soft due to product mix and a one-time labor cost. The company is funding a massive 254 crores capex from its own pocket and customer advances. This is institutional grade health. The company's Saharsh Davuluri is transparent about the lumpiness but firm on the preordained CAGR. The growth for the next 2 to 3 years is kind of preordained. We just need to execute. It shows that the orders are in the house. The risk is now purely operational, not commercial. And the company also has several multi-hundred crore molecules in its CMS pipeline. So this shows that the unit value per project has structurally shifted higher. The margin for this quarter is a function of various things. It is more of an outlier. So here management is expecting that we can expect a reversion to the 25 to 30% EBITDA range as the mix normalizes. And it would be ideal for Neuland in fiscal 2027 if we were able to secure at least one commercial manufacturing arrangement for a peptide NCE. This is the north star for the peptide investment. And finally, on the ramp up, which is going to take maybe another 1 or 2 quarters, is to really pick up. So Q4 also will likely be a lumpy, and the final bull story could be seen in fiscal year 2027 play. So while management talks about acceleration in technology, there is a noticeable gap in explicit AI adoption for process design compared to global peers. Furthermore, the unit 3 ramp up is taking time. Investors must watch if execution matches the preordained rhetoric. And management also refuses to play the quarterly guidance game, which is a sign of maturity. They are upfront about customer end failures like paliperidone and focus on decadal growth. They aren't trying to smooth the volatility, they are trying to build a titan. And coming to its some of the KPIs, its working capital is at around 145 days. This needs to be moved towards to 90 days. And 9 months gross margin also stood at 56%, the true steady state indicator. And coming to 9 months capex, it is at 254 crores, which is the price of future growth. And coming to its commercial molecules, which are stagnant at 19, but value per molecule is rising as they shift from small biotechs to big pharma engagements. So coming to its valuation, the company is nearly trading at 90 times. So Neuland isn't cheap. It's a different asset class compared to Dr. Reddy's, which is trading at 19 to 20 times. you are paying for high conviction peptide call option. So in a bear case scenario, if there is an extended paliperidone delays and inventory write downs, so multiple compression can see as the market loses patience with the working capital bloat. In a base case scenario, we can see 20% CAGR execution plus successful peptide monetization, which can see multiple maintenance. In a bull case scenario, if big pharma peptide partnership plus margin reversion to 30%, then we can see multiple expansion as Neuland is re-rated as a global specialty manufacturer. So the stock is expensive on yesterday's earnings, but potentially fair if you believe the 20% CAGR narrative. You are paying a premium for the future peptide capacity today. So what are the some key risks which I observed in this company are the first is customer operational risk. The paliperidone delay is a mechanistic reminder that Neuland is a hostage to customers' operational success. Second risk is capital misallocation. If the peptide investment doesn't find a commercial anchor by fiscal year 2027, the ROE will take a hit. And the third is inventory bloat. Profits are currently trapped in raw materials. If the revenue ramp up stalls, the cash flow pressure will become real. Some key monitorables which we need to track in this company are its July commissioning, whether they will be successful in launching new peptide capacity or not, and whether it can win at least one commercial NCE peptide contract in fiscal 2027 or not, need to be checked. And working capital cycle, whether it can get down to 90-day target or not, we need to see. And margin reversion, whether it can reach to the 25% plus range or not. And Genome Valley's operational facility of the new R&D center need to be tracked, and unit 3 timeline for the facility reaching 100% production utilization. So Neuland Laboratories is an execution play disguised as a volatility play. The business has structurally moved from being a generic vendor to a high-end partner for complex molecules, yet it is still being judged by the lumpiness of its quarterly transitions. The bull case is simple. Neuland has a debt-free balance sheet, preordained revenue growth from existing commercial molecules, and a massive unpriced call option on the global peptide shortage. While the 90 PE requires a strong stomach, the strategic shift toward the high value NCEs suggest Neuland is just entering the early phase of its decadal growth cycle. Hope you like this video. If you do like this video, please do like, share, and subscribe to Murthy Finance Academy. And if you want me to cover on any other specific company, please write it down in the comments. I will make that happen. Thank you.